We often wonder, why do most successful investors go contrarian? What makes them go contrarian? What makes them develop the conviction to go contrarian? There's a madness that's attached to this contrarian approach of theirs. But did the madness come overnight? No, it develops over a period of time. There's a specific method to it. Welcome to episode 1 of Method to Madness podcast by beyondMF. Today, we have a very special guest with us. He has over 3 decades of experience across public equities, portfolio management services, and fund management across various asset management firms like HDFC Mutual Fund, Zurich India Mutual Fund, and PGIM Mutual Fund. We are very, very happy to welcome Mr. EA Sundaram, the Executive Director of Bugle Capital, who joins us on our discussion today. Today, we wanted to speak to him regarding the specific aspect of investing which focuses on the temperament part and not on the analysis part. Because I think most videos today focus on the analysis part of investing. Thank you so much for joining us today.
Thank you for inviting me. And I'm particularly pleased that you've chosen this topic. It's close to my heart. It's been a pet theme of mine at several forums that I have focused and stressed on the building a proper temperament for investing, because it's been my observation that the analysis part of investing, the number crunching, gets the attention it deserves, but the idea of building a sound temperament for investing unfortunately hasn't got the attention it deserves. So I'm very happy to be here for this reason.
So you've been a contrarian pretty much your entire life, right? But did this contrarian approach start off right from the beginning, or did it develop and form over a period of time?
See, nobody is born with an investment approach.
Right.
I think the investment approach is molded and modified and refined based on the experiences that each individual goes through, and also based upon the the learnings that we have had by meeting other good investors, and also by what we read and so on and so forth, and what we observe. So I think this thought of going the contrarian way actually started to take shape after certain experiences that I have had as a fund manager. The 1995 IPO boom and bust, and then the 1999-2000 new economy boom and bust. These were cathartic experiences for all of us. And we have learned hopefully a lot from these things. Plus, of course, there were some great books that I read along the way, and I've been lucky enough to meet some really great investors in India and learned from them. So I think this process has been a refinement over several years, and I've tried to put that process and made a template out of it. So that's I hope I am now a better investor than what I was 20 years ago.
So that brings me to that question that we spoke about initially, right? About habits shaping your decisions. There are certain habits that don't need to be linked to analysis or your investment related prowess, but still that would have contributed a lot to your investment success. What are the top 3 habits that you would attribute to this to your investment success?
Just as everything else in life, habits also shape our investment decision making.
Right.
So I would say that I would like to discuss 2 habits that we should stay away from and 2 habits that we should inculcate. There are good and bad habits in investing also, as in anything else in life.
Right.
If I were to talk about the habits to stay away from, the first and foremost is the habit of being bothered too much about how much money somebody else has made.
Right.
Usually this is the cause of the problem.
Right.
Because most people left to themselves, I think, will be happy with a 16-17% rate of return from the Indian stock market until they see that their neighbor has made 30%.
Right.
That is where the problem will start.
Right.
See, up to a point, competition is good. But beyond a point, competition gets destructive. Especially in certain situations where there is a roaring bull market, a wild bull market. If in that situation we want to be the best or earn the highest return, we can do that only by significantly diluting the risk control levels in our portfolio, and that is a bad habit.
Right.
So that is one thing we should stay away from.
Right.
The other point which I would like to stress in this conversation is that let's not expect to make the maximum returns at all points of time. It is not necessary.
Right.
I think it is very, very essential that the investor focuses on being consistently good. It is simply not necessary to try and be the best. This is one habit we should get out of.
Right.
About the habits that are good for us and we need to inculcate, I would like to point out that, maybe the more important thing is having the willingness and ability to say, I don't know, at some points of time.
Right.
Because none of us is capable of knowing everything.
True.
And there's no shame in admitting it.
Right.
So if we don't know something, in my opinion, there is no point in pretending to be more intelligent than we actually are.
Right. Sure.
Just say, I don't know. Of course, we should make an attempt to know.
Right.
And after a reasonable, diligent effort also, we are unable to understand that business or that particular technology. It's fine. You don't have to know everything. That's one habit that we should inculcate.
Right.
The second one, which is good to have as an investor, is to have the open-mindedness to do course correction if we have noticed that something is going wrong in our investment thesis.
Right.
Nobody gets it right all the time.
Right.
So, but if we get it wrong, then we should have the humility to admit it and the open-mindedness to do course correction after we've realized that we have made a mistake.
Right.
These two habits are good.
Wonderful. Wonderful. Since you mentioned that you're still a market learner of the market, right? Because you've had 3 decades of experience and you still believe that you're a learner and you are going to learn perpetually, right? So because you've managed portfolios, you've managed your own portfolio, there's an apparent difference between the two. It's not the same. Managing your own risk and managing public portfolios are two different things. So as a student of the markets, as an experienced student of the markets, what are the biggest lessons that you've seen in fund management?
There are several.
Right.
I think the foremost amongst them is that we have to be clear about what need we are fulfilling for an investor. It's important to articulate it. See, we don't have to be all things to all people.
Right.
And this is more particularly relevant from the portfolio management or PMS point of view. Why I am saying this? Because the PMS, the threshold of minimum investment is actually quite high.
Right.
And nobody gives 100% of their equity allocation to one PMS manager.
Right.
So if we are talking of a person who is capable of writing out a check of that kind, it probably is somewhere between 6 to 15% of his overall equity allocation, his or her equity allocation. So
right.
We are talking of somebody who's significantly affluent. And this set of people have certain needs.
Right.
It is my observation that a person of that kind is not investing to get rich because he or she is rich already.
Sure.
Their primary concern has been, I have made my money the hard way. I am entrusting it to this portfolio manager to take care of it properly. I don't want some smart elect to come and destroy it for me.
Right.
So that the primary concern is that they want a logical investment process and a process that is different from what they are getting elsewhere. Because a client of that kind has a choice, a wide variety of choices.
Right.
So a PMS portfolio will make sense to them only if it has a portfolio or a diversification that they are not getting elsewhere. That's one part.
Right.
Therefore, it's important to clearly articulate what the client will get and will not get if he or she chooses to be in our portfolio. That's one
right.
learning.
Right.
The other part of it is an extension of it. Actually, the asset management business, in my opinion, is a very simple business. There's no need to unnecessarily complicate matters.
Right.
Clearly articulating what the client will get by choosing our portfolio. Number two, doing exactly what you said you would do. And number three, periodically reinforcing to the client that you're indeed doing it.
Right.
These three things are important.
Right.
Apart from that, I think the process should focus on eliminating costly errors rather than trying to do anything spectacular. I think it's been my learning and my experience that if we focus on eliminating the big errors, we'll accomplish more than most people. So the focus is not on maximizing returns. The focus is on minimizing permanent losses. That's the approach that I would suggest to anybody. The fourth thing is, it's also important that how much of a stock we buy. It's not important if we identify a good company to invest. How much of it to buy and how much of it to include it in the portfolio is also important. If we like an idea, we can't overload the portfolio with stocks from that sector alone.
Right.
So position sizing becomes important. That's
Right.
the second thing. And not all stocks meet the same requirement in a portfolio. There are some stocks which are purchased deliberately to steady the portfolio during turbulent times.
Right.
Not everything is purchased to maximize returns. There are some which we buy for high growth, some which we buy as a stabilizer in the portfolio. So both of these things are important.
Right.
There are things like, if you don't understand something, it is better not to go anywhere near it.
True.
So I think these are some of the lessons, and of course there are other lessons which we keep learning, but I think these lessons are important and should be kept in mind when we construct and manage a portfolio for somebody.
Understood, sir. So since you mentioned about turbulent times in the previous answer, I wanted to ask you this question about the last few years in the markets. They've been pretty much rewarding for most of us, except for the last couple of months maybe. And we always know time and again market generosity does not extend beyond a certain point of time. I think it's already showing up today as we speak. So today, is there a serious case for bottom-up investing to have more relevance? So some thoughts on that today, sir.
I do not think that bottom-up investing will ever lose its relevance.
Right.
See, first of all, if you and I agree on this point, that the purpose of the capital market is to reward efficiency in the use of capital.
Right.
Or conversely, punish inefficiency in the use of capital. If that is what the capital market is all about, then bottom-up investing is just having a process to be in sync with this basic principle. That's what shorn of all jargon.
Right.
Bottom-up investing means buying businesses that are strong and competitive with strong balance sheets and buying them at prices that are not exorbitantly expensive. How can this ever become irrelevant?
Very true. Very true. I think that's the innate nature of investing. That is what you're trying to say.
That's the first principle of investing. Buy a strong asset at prices that are not exorbitantly high.
Right.
So this will never become irrelevant.
Right.
I don't think so.
Right. So since we spoke about this, I have this analogy that we spoke about in our initial discussion about us driving on the highway. Let's say we are driving at 100, 120 and suddenly we have to go through a city road and we are dropped to 40 to 60. That sometimes frustrates us, right? We are in the mindset of 100 km per hour while we are brought down to 40 to 60, which still is a good speed to drive on the city roads. But still we are frustrated. Do you think the market is looking at that kind of a move today or anything on that?
It's interesting that you brought up this driving analogy.
Right.
Because one of my favorite quotes, and I've used it in some of my newsletters and communications to investors also, is from a racing car driver.
Right.
Okay. He has nothing to do with the stock market, but his quote is immortal.
Right.
It's from a guy called Rick Mears, who's the 4-time winner of the Indianapolis 500 car race.
Right.
He has said, to finish first, you must first finish.
True.
I think it's a remarkable quote.
Right.
And I find it very relevant for the investment world.
Right.
More important than finishing first is to complete the journey.
Right.
So you should live to tell the tale, right? So there is no point in loading our portfolio with unnecessary levels of risk. As I said earlier, and I don't mind repeating any number of times, it is important to be consistently good. It is simply not important to try and be the best.
Right.
Because the best is a transient position in any case.
Right.
So I think there will be periods of slump. There will be periods of exhilarating rises. We should learn to treat both of them equally.
Right.
About how the market will behave from now on. I think it's important to have a reasonable level of expectation from India's stock market, and for that I think some data is available.
Right.
If we look at the long-term correlation between the corporate profitability of Indian companies and the returns the stock market has generated, there is a strong, almost one-to-one correlation. I am taking the BSE 200 as the database. Because
Right.
BSE 200 is a fairly diversified index, so
Right.
it gives a good flavor. Over the last 20 years, the net profits of the BSE 200 companies has grown at about 14.5%. The BSE 200 index has also grown at about 14.5%. So there is a strong correlation.
Right.
So it's important for us to know and to come to some conclusion about how much the net profits will grow from today onwards. So let's start with some assumptions. Let's start with the assumption that this economy is capable of growing at about 6.5% in the foreseeable next several years. I don't think that's an unreasonable expectation.
Right.
So if India grows at 6.5% GDP, so in nominal terms, we are growing at somewhere between 12 to 13% GDP.
Right.
If the whole GDP grows at about 12 to 13%, we can, I think, again assume that the industry and services part of the GDP will grow at slightly higher rate, because agriculture doesn't grow as much as industry and services.
Right.
So if whole economy grows at 13%, industry and services can grow at probably 14 or 14.5%.
Right.
I don't think we can factor in substantial improvements in profitability. If
Right.
you see the last 25 years, the average net profit margin of corporate India has been 8.7% to revenue.
Right.
And in the last couple of years, it has risen about 10%. So
Right.
I don't think there's any scope for substantial improvement on that front.
Right.
So even if we assume that it stays stagnant at 10%, so if the revenues grow at 14.5%, the net profit should grow at 14.5%.
Right.
So it is a reasonable expectation that India's stock market, provided we are confident that the GDP will grow at 6.5%, will grow at about 14.5%.
Right.
So that is the expectation from India's stock market as a whole.
Right.
But the stock market is not a monolithic single entity. There will
Correct.
be individual opportunities that are superior.
Correct.
And there will be slumps in between. There will be exhilarating rises in between. So I am talking of the average for the next several years.
Understood.
So I hope that answers your question.
Definitely, sir. So, since you spoke about individual ideas, right? Most of us are very focused on selling at the top and buying at the bottom, and we know stocks hit tops and bottoms at different points of time. But most experienced investors like you know that you try to somewhere fit into the middle of the path, right? You don't try to sell at the top or buy at the bottom. You try to find the middle somewhere, right? And that itself is a struggle. Right. With that in context, which do you think is the lesser evil of the two? Compromising or going easy on margin of safety by buying a little bit higher, or going easy on opportunity cost by selling a little lower?
I don't think they are, contrary to each other.
Right.
Both are important.
Right.
What is more important is that you don't buy something simply because it is cheap.
Right.
You should buy a good quality asset when it is not too expensive. That's the idea.
Right.
And we will know that we have crossed, we will know that it is a peak of price only after we have crossed it. So
Right.
I don't even attempt to sell at the peak.
Right.
As I told you, there is a system that we have developed, a system of what we mean by an expensive stock, what we mean by an acceptable price.
Right.
The same system, the same measurement tells us that when it becomes too expensive.
Right.
So when in our opinion, it becomes too expensive, we begin to prune it. We don't sell in one installment, we sell over several installments, just as we buy over several installments. So the idea is never to buy a stock at the bottom or sell it at the peak.
Right.
Speaking for myself, there are 5,400 listed companies in India.
Right.
We need 25 to build a portfolio. And obviously, there will be some opportunities we'll miss. We can't buy all the stocks that move up.
Absolutely.
Speaking for myself, I am much more comfortable losing an opportunity compared to losing money permanently.
Right.
I have no problem in losing an opportunity. If one goes, another one will come.
Right.
But if money goes permanently, it's not going to come back.
True.
So
True.
I think that's the focus.
Understood, sir. Understood. So you spoke about investors, or rather, you always speak about common sense investing, right? And it's very easy for you to know what is common sense investing, but it's very hard for you to implement it. That you've always carried that. So the most successful investors or fund managers across the globe get 6 to 7 out of 10 ideas right. Which means even the most successful fund managers leave room for mistakes, and they respect the law of probability. So what is your take on how much should this room be and how to create this room?
7 out of 10, I think, is a very good track record to have.
Right.
If I'm right in 7 out of 10 cases, I think the client has a pretty decent result.
Right.
In lucky years, I get 8 out of 10 right.
Right.
I don't think 9 out of 10 is possible for me.
Right.
And I don't believe 10 out of 10 is possible for anybody.
Right.
There will always be some things that don't go the way we envisage it will go.
Right.
The best way to safeguard ourselves are only two things. That there's really no other way. Don't buy into a company simply because it came cheap, or don't buy something simply because it is in the move. Or
Right.
Please let me clarify here. I'm talking about my investment style.
Right. Right.
I am not claiming that everybody should follow this style. My investment style is that we focus on buying businesses which can withstand a difficult time.
Right.
Right?
Right.
So even if it doesn't outperform for the next 6 months, I don't lose any sleep because I know that I've got a good company.
Right.
Secondly, even if it's the best company in the world, I don't want to overpay for it.
Right.
So there are strict parameters of what we mean by an acceptable price and what we mean by an expensive price. I
Right.
try to follow that.
Right.
Let me give you the example of a very strong company which everybody knows about.
Right.
Infosys, between 2000 and 2006, a 6-year period,
Right.
the profits of that company grew by 36% per annum. But the stock grew by 4% per annum during this period.
Right.
The same Infosys, between another 6-year period of 2016 and 2022, the profits grew by 8% per annum. But the stock grew by 21% per annum.
Right.
So I'm saying this because often I hear an argument saying that as long as the earnings growth is robust enough, the entry price doesn't matter.
Right.
I can't agree with that because
Right. Absolutely.
the difference between the two scenarios that I gave you was in 2000, Infosys stock was available at 100 PE multiple.
Right.
In 2016, it was available for 12 PE multiple.
Right.
The
Right.
same company.
Right.
So it's important that we choose a good company, and it's also very important that we don't overpay. So
Right.
this is how we balance between the desire to be right and the possibility that we can be wrong also.
Definitely. On that, sir, on the possibility of you being wrong, let me get a little personal with this question. That is there any example of a blue chip company that didn't perform for, let's say, 4 to 5 years the way that you envisaged? How did you exactly handle this situation, sir?
See, I think communication is the key. I'll give you an example of my own portfolio that I'm managing now.
Right.
There was this company called Oracle Financial Services Software.
Right.
I bought it in 2019.
Right.
In 2023, it was at the same price.
Right.
We persisted with it.
Right.
But in 2024, it compensated for the waiting period.
Right.
The way to do it is we be clear about why we bought that share. And as long as the reasons for purchasing that share are still relevant, and as long as the fundamentals have not deteriorated, and as long as the price is still right, persist with it. And more importantly, communicate to our investors who have entrusted their money to us that this is the reason why we are persisting with it.
Right.
Because they also have to be convinced.
Absolutely. Sure.
So keep doing the same thing over and over again. And the stock market has never moved in a linear fashion.
Right.
There are periods of frustration followed by periods of exhilarating growth. So it's important that if you're on to a good thing, don't be frustrated by the wait.
Right.
It's a very important aspect of investing.
Absolutely.